let's talk about the forecast for the Canadian dollar. Where is it headed?
Well, it certainly appears that we're going to go a little bit lower from where we are. We're heading into sort of one of those classic year-end funding crunches in the global financial markets. We're starting to see scarcity of dollars across the global economy, and so very likely we push down, closer to 70 cents than where we are today. That's the level that we hit twice in the last decade, and it does look very much as if momentum is taking us there again.
Let's talk about those daily fluctuations and what's driving them.
Sure. So, I think the big shift here is that through this year, we've had a number of major shocks. We've had a global energy shock that has hammered demand across most global economies. We have had the Federal Reserve suddenly tighten policy more aggressively than had been previously expected. And we're beginning to see things break elsewhere. We're beginning to see interest rates rise to sort of intolerable levels in economies like Canada's that are heavily leveraged. So wherever you have a lot of debt right now, we're seeing the tide go out, which sort of reminds me of what Warren Buffett once said about, when the tide goes out, we see who's swimming naked. That's essentially what we're seeing across most global currencies right now is traders and investors worrying about where the next shoe might drop, where the next problem might surface. It is a very fragile period in currency markets and financial markets more generally.
Let's just expand on some of the elements that you had touched on. The price of oil always tied very much to the Canadian dollar. The higher the oil prices, the higher the dollar. What's going on right now?
Right now, we're not seeing that relationship hold as strong as it did for the last couple of decades. So, kind of an interesting sort of history lesson, I guess, if we roll this way back. Back in the 80s and 90s, the Canadian dollar was not correlated with oil prices at all. In fact, it was inversely correlated. When oil prices went up, the Canadian dollar tended to fall. And the reason back then was that we knew that if the oil price went up materially, that US demand would suffer and the Canadian economy would suffer next. This time around, what we're beginning to see is global markets being far more concerned about the Canadian housing sector, but what Canadian consumers might do, than what might happen in the energy sector. The energy sector itself is contributing relatively little to GDP relative to that overall consumption and real estate engine that has powered Canada for many years. So ultimately, what's happening right now is investors no longer see Canada as a Saudi Arabia of the North. They're seeing this as a very fragile housing-driven economy, and they're walking away as quickly as they can.
Let's talk about fiscal and monetary stimulus. You had touched on the Fed pulling back on, or ending rather, quantitative easing. What does that do to our dollar?
Well, quantitative tightening in and of itself likely isn't a big force. We do know that is going to lead to some funding strains in the markets, but the big picture here is certainly where rates are going. And the fact that the Fed is hiking aggressively, that incoming data is pointing toward persistence and underlying inflation pressures, all of that is raising the terminal rate expectations in the US. We're seeing rate expectations move to 4.25%, 4.5%. We're seeing expectations for 2023 not coming down by that much. Until August, we had a very big contingent in the market that was looking for a pivot in 2023. That is no longer the case. The expectation is that rates will move higher and stay there for longer. All of that taken together is raising interest rates, even in across the global economy, particularly in economies like Canada's. And what that's doing is putting pressure on Canadian households that are looking to roll over mortgages. So when you're looking to roll over a mortgage today, your 5-year mortgage rate has risen by more in percentage terms than it has since 1983. So you're looking at a very big shock that is very likely to lead to a consumption crunch in Canada, lead households to spend less money, and slow the overall economy.
Let's talk about inflationary pressures. And I'm also wondering whether or not we see a spillover from US inflation into Canada.
Oh yeah, I think unquestionably the U.S. demand scenario coming out of the pandemic has been the primary motive force for global inflation. In other words, the fact that consumers in the U.S. have continued to spend at the levels that they are, that has driven prices up globally. Now, what we are beginning to see is a shift in that behavior. You're seeing American consumers shifting from, the durable goods and sort of tangible goods that they were consuming during the immediate months after the pandemic towards services. What that's doing is shifting the direction of inflation. So we're seeing, commodity prices come down globally. You're seeing shipping and logistics costs easing. You're seeing, that overall supply chain stress going away, but you're seeing inflation beginning to surface in the services sector. And all of that transmits across to Canada in the sense that it raises global prices for the goods and services that we consume. So ultimately, what you're looking at is a U.S. driven rise in inflation that does impact what we pay here in Canada. And unfortunately, as the Canadian dollar falls, that exacerbates the price that households pay here.
Carl, lastly, when you take a look at the Canadian dollar versus global currencies, where do we stand?
Right. So the Canadian dollar has actually outperformed most global currencies this year. It is, sort of at the top of the league tables, despite the fact that the US dollar has steamrolled virtually everything. Although we have seen a loss in purchasing power here in Canada, the fact that we have a large commodity export sector, the fact that we are parked right next door to the United States has definitely benefited Canada and the currency. And so, to some extent, we're protected by geography as well. The fact that, you do have this energy shock hitting Europe, the fact that in China, we are seeing a prolonged and persistent slowdown. Canada is somewhat insulated from all of that simply by dint of geography. And so, to some extent here, we're doing relatively well, but I would certainly caution that while bad news has been priced into many other currencies, including the pound, including the euro, even the renminbi, and the yen, Canada likely has a little bit further to go. We still have, a number of vulnerabilities in the Canadian economy that have not necessarily been appreciated by traders or investors, and that very likely do come to the surface over the months ahead and drag the currency down.